If your mortgage rate starts with a 3, a 4, or a 5, there's a decent chance refinancing right now would actually cost you thousands of dollars instead of saving you thousands. And most homeowners don't realize that until it's too late. That's the strange part about where things stand in 2026. The headlines make refinancing sound like an obvious when the moment rates dip even slightly. But for the majority of homeowners, the math tells a completely different story. By the end of this video, you'll know exactly where mortgage rates actually stand today, whether refinancing genuinely makes sense for your specific situation, and the real formula you should be using instead of guessing. You'll also learn the one move a lot of homeowners overlook completely, an alternative that could get you access to your equity without ever touching the low rate you already have locked in. Now, a 30-year fixed isn't your only option here. 15-year mortgage rates are running almost a full percentage point lower right now, which can mean serious long-term interest savings if you can handle the higher monthly payment. Adjustable rate mortgages are priced even lower still, but they come with real trade-offs. Your rate can reset significantly higher once the initial fixed period ends, so they only make sense in specific situations. Here's the twist that changes everything. Roughly 82% of homeowners in the U.S. already have a mortgage rate below 6%, according to recent data. That's the vast majority of people watching this video, which means for most homeowners, refinancing today wouldn't lower their rate at all. It would actually raise it. You'd be trading a mortgage you locked in years ago for one at today's higher pricing. Your credit score plays a much bigger role in this than most people realize. Every average rate you see quoted online assumes a strong credit profile, usually a score in the high 700s or above. If your score has dropped since you got your original mortgage, even by a modest amount, the rate you're actually offered today could run noticeably higher than the numbers splashed across the headlines. You've probably heard the classic advice: only refinance if you can lower your rate by a full 2 percentage points. That used to be the standard rule almost everyone repeated without question. The problem is that rule was built for a completely different mortgage market, one where closing costs and loan structures looked very different from how they work today. It just doesn't hold up the same way anymore. The real number worth using today is much smaller, somewhere around half a percentage point to 3/4 of a point lower than your current rate is usually enough to make refinancing worth exploring. That's because closing costs on a refinance typically run somewhere between 2 and 6% of your total loan amount. And that upfront cost is exactly what determines whether a smaller rate drop still pays off. Let's make this concrete with real numbers instead of just percentages. Picture a $500,000 mortgage loan, since that's a realistic loan size in a lot of markets across the country right now. Dropping the rate on that loan from 7% down to 6.5% cuts the monthly payment by roughly $150. That's real, meaningful savings, but it still has to clear your closing costs first. Here's something most people don't know, and it's honestly a little wild. Mortgage rates actually dropped all the way down to 6.09% just months before this video was made. Then they jumped right back up, climbing nearly 70 basis points in a fairly short window. The reason wasn't anything to do with the housing market directly. It was rising oil prices tied to overseas conflict. That's the lesson worth sitting with for a second. These rates can swing hard and fast because of events that have absolutely nothing to do with your personal finances, your credit, or your income. Here's a smaller but still useful point. Right now, rates aren't varying a huge amount from one lender to the next. The overall market is fairly calm compared to some periods in recent years. But that calm doesn't mean you should skip comparing offers. Getting quotes from at least a few different lenders on the same day can still uncover a meaningfully better deal than just accepting the first one you're offered. Okay, let's actually walk through the break-even math step by step, because this is the part that tells you the real answer, not just a gut feeling based on a headline you scrolled past. Start with your total closing costs. Again, roughly 2 to 6% of your loan amount. Then divide that number by how much you'd actually save on your payment every single month. Whatever number that division gives you is your break-even point in months. If you're confident you'll stay in the home longer than that, the refinance likely makes sense. If not, it probably doesn't. One more detail worth understanding before you compare any loan offers. The interest rate you see advertised isn't actually the complete picture of what a loan costs you over time. The APR, or annual percentage rate, wraps in lender fees and closing costs alongside the interest rate itself, which makes it a much more honest number to compare between different lenders and loan offers. Now, there are absolutely still situations where refinancing makes sense even without a big rate drop. Converting an adjustable rate mortgage into a fixed rate before it resets is one of the strongest reasons to do it. Shortening your loan term is another one. Moving from a 30-year to a 15-year mortgage means paying significantly less interest over the life of the loan, even if your monthly payment goes up somewhat. And if you're facing real financial hardship, waiting for perfect market conditions isn't always realistic. Sometimes, even a modest reduction in your monthly payment can make a genuine difference to your household budget right now. Now here's where I'd urge some real caution. A cash-out refinance means giving up your entire existing mortgage, even a great old rate, in exchange for a brand new loan priced at today's higher rates that you're doing that just to access some of your home's equity and at current rates. That trade is rarely the cheapest or smartest way to actually get your hands on cash. A much more common alternative these days is a home equity line of credit or a home equity loan. Both let you borrow against your equity without disturbing your primary mortgage at all. That means your original, often much lower rate stays completely untouched on your main loan, while you still get access to the funds you actually need for whatever the purpose might be. So let's bring this all together. Rates are hovering in the mid 6% range right now, well above what the vast majority of current homeowners are already locked into paying. The old 2% rule is outdated, the real threshold is closer to half a point, and your break-even math is the only number that actually tells you the truth about your specific situation. Don't refinance simply because a headline claims rates dropped this week. That framing almost never tells the full story of what it would actually mean for your particular loan and your particular numbers. If you're not sure where you stand, drop your current interest rate and your remaining loan balance in the comments below, and I'll walk through what the math would actually look like for you. And if this helped clear things up even a little, subscribe for more breakdowns like this one. Plain English explanations of the financial decisions that actually affect your bank account without any of the fluff.